Hello and welcome to Mutual Fund Corner on CNBC TV 18. I'm Vinny Motiwala in the Mumbai studio. Let's talk about the union budget that was just taking place on 1st of February, and that was the Saturday. Now, Union Budget 2025 has introduced several measures that we saw that was aimed at empowering the middle class. Tax relief of up to 12 lakh rupees under the new tax regime for all those with the salary of 12 lakh rupees was one of the key highlights that came in on the budget. And this is a decision that is likely to boost, the consumption side, maybe an investment that could see a boost coming in, including mutual fund industry. Is that what we could see maybe? We're going to discuss all of that with Mihir Vora, Chief Investment Officer at Trust Mutual Fund, joining with us. Thank you so much, Mihir, for joining with us this afternoon on CNBC TV 18. It's a pleasure having you on the show. Budget surely has made a lot of announcement. Everyone was cheering when they heard that, for the salary employees, the 12 lakh rupees, you do get that relief coming in. But, what do you think are the factors that might actually have come in from the budget, the measures that have come in from the budget? Do you think that is something that will boost the consumption story? Do you think that is something that we could see an increase coming in maybe on the investment side?
Certainly. First of all, thanks for having me on the show. Always a pleasure. See, the budget provisions for the middle class and the taxpayer, I think, impact the economy in a couple of ways. One is, of course, the fact that you have more money in the hands of the taxpayer, which they can consume or save or invest whichever way they want to. There is also, a relief from the perception that it's only the taxpayer who is bearing the burden of economic growth, so to say. So there was this underlying, resentment, so to say, because of increased taxes and the increase in the capital gains tax in the last budget, etc. So there was a thing that, it's only the taxpayer who's bearing the burden of growth, but now at least it seems to be more fair. So that's a, sentimental relief, I would say, and sentimental positive. And hopefully the consumer animal instincts, animal spirits, as we call it, should come out. But coming back to the, actual budget, the provisions are significant. It should unleash about 1 lakh crores of, extra money into the hand of the consumer. About 1.8 crore taxpayers will benefit, and to the extent of almost 4 to 5% of their net salary. So it's a significant boost. About, I would say, 1 lakh crore is about 0.3% of GDP. So it's significant, not earth-shattering, but as I say, significantly high enough to kind of create a positive consumption wave. The other thing that one can also see is that part of it may go into consumption, part of it may go into savings, but if it goes into investment, which is a leverage, then the multiplier effect can be more. So, for example, if with 1 lakh rupees per year, you end up buying a new house, then it's a leverage bet. Then you can actually end up with a higher multiplier of that 1 lakh crores.
Absolutely. Just to follow up on this one, that, obviously the SEBI's new rule had come of this, SIPs of 250 rupees, as low as 250 rupees is what you could start. With these given factors combined together, is there a possibility that maybe that saving that we could see coming in from the investor is maybe something that is possibly higher, that we could see shift coming towards the mutual fund side or the
Certainly. Side? So this 250 rupees is probably a very small step. The big one is, of course, this 1 lakh crores that we have extra in hands. And as I said, part of it can come into savings. And if it comes into savings, not through lump sum, but SIP, then it becomes, as I said, even more sustainable for the longer term.
Absolutely. Now, one thing that came in the budget and those decisions that came in was that they were maintaining the current long-term capital gains and the short-term capital gain tax. How should an investor actually approach their equity as well as the debt mutual fund in terms of allocation right now after the budget?
Sure. So we started, at least I started the budget with the attitude that no bad news will be good news.
Good news. so even a slight bit of a positive news, I think everyone was happy with that.
So there was no hike, no tweaking around with the capital gains. Of course, you have the new income tax laws coming in the next couple of days. So hopefully, again, that should simplify things a lot more. But in the budget, from the asset allocation point of view, does it kind of warrant any change in mix? I would say no. But having said that, one should stick to the long-term strategy. So equity is always for long-term wealth creation. Fixed income is always for capital preservation and regular income. So typically what I would recommend is that anything which is less than 2 to 3 years in maturity, or if your cash flow requirements are anywhere in the next 2 to 3 years, then probably that portion you want to keep it in the fixed income segment. And for the longer term, you want to put it in the equity funds.
Okay. No, now typically talking about a separate class of investors, that's like who's more aggressive. Typically, they are like higher risk and they want the higher tolerances there for the risk and may seek to maybe look at higher equity exposure. What sectors, themes, anything that you anticipate could benefit specifically, given the budget announcements that have come in? And what should they be capitalizing on? What opportunities are there for them in the mutual fund industry?
Sure. So for the aggressive person or the investor, obviously it makes sense to be in equities. But just on the previous question, I forgot to mention that our view on fixed income is also positive, by the way.
Okay.
So for the moderate or not so aggressive investor, we do believe that you can make 8 to 9% over the next 2 to 3 years in the fixed income funds because we're expecting a rate cut cycle. So that's something that to keep in mind when you're kind of calculating your risk return. But coming back to the the aggressive investor, assuming that he's a sophisticated investor, now has a wide choice of funds to choose from. Wide range of funds to choose from. You have the large cap, the flexi cap, the multi cap, the sectoral funds, the thematic, small cap, mid cap, everything. So I think beyond a point it becomes a challenge. So what I would recommend is that the diversified funds like flexi cap category should always be your core, right? The main cake, and the thematic funds, the other funds, small cap, mid cap, can be the icing on the cake, but it should not be the main cake. The reason why I say that is that when it comes to thematic funds or sectoral funds, the responsibility is on you or your advisor to advise you to get in or out, because no sector or theme typically lasts forever.
Yeah.
Whereas a diversified fund can churn and select the upcoming sectors, give more allocation to the faster growing segments, and then when the cycle or theme turns, you can shift back to other, which you can't do in a sectoral or a thematic fund. So the responsibility then becomes of you or your advisor.
If you're going for those funds,
exactly. So it becomes more of an active management from your side.
Yeah.
That's the thing that you need to understand when you're talking about sectoral or thematic funds. It's very exciting to see ads and put
it does interest you. Like last whole year, whenever anything used to come, you were quite pumped up by those sector funds, thematic funds.
Absolutely.
So that story is something, but you have to be very aware when you take such decisions.
Go in with your eyes open, and you also need to plan for exit.
Yeah, that's also important, because sometimes you're stuck in it. You're like, okay, it's going to do well, but understanding those situations and the sectors specifically would be an important one. Okay, Mihir, there was one more thing that came in, is that there is an increase in TCS threshold, and this is under the LRS side, right? And this is from 7 lakhs to 10 lakhs. How does it affect investors, especially who are looking at international mutual funds? Could you explain that? And what should one be doing in strategies for international mutual funds?
Sure. So when you remit money, there's a tax collected at source, which is not a tax per se, it's just an advance, and when you file your returns, you claim it back. But there's a cash flow mismatch, right? So when you're remitting, say, 7 lakh, beyond 7 lakh rupees, then the incremental amount you want to invest, then you need, if you're remitting, then you probably have to, your bank will retain 20% of it, which you can claim back later. So it becomes a cash flow issue, right? So if you are investing, say, 10 lakh earlier, you would probably have to pay TCS on the incremental 3 lakhs, which you can claim back later. But it's a cash flow issue, right? So now the threshold has been raised to 10 lakh rupees. So now beyond 10 lakhs, you still have TCS, but at least for 3 more lakhs, you don't have to pay TCS, which means that your upfront investment amount is higher.
True.
So it's a cash flow, so the irritant of, having to 3 lakh 20, so 60,000 rupees, you could have invested if there was no TCS, but now you have to pay and then claim back. But now you can invest those 60,000 extra up to